Hey guys, welcome back to the channel. Today's video is all about getting pre-qualified. I wanted to have a casual conversation with you about what it would really take to be able to get pre-qualified, okay? You start the journey of wanting to buy something. Typically, it could be your primary residence, could be an investment property, whatever it may be, as long as it's residential real estate. And the thing is, you have to make sure that your finances line up with whatever it is you're trying to purchase, right? You want to make sure that you are qualified to purchase it. So the way pre-qualified works, different than pre-approved, is that if I'm going to have a conversation with a borrower and they're going to basically tell me about their income and their expenses, I could tell them that I could pre-qualify you based on this phone conversation, whereas I know that your total expenses, including the new mortgage, would be less than 50% of your income, all right? And that would be considered me pre-qualifying you. However, if you wanted to get pre-approved, we would have to go through the journey of documenting that everything you're telling me lines up with what your documents are telling me, including your credit. So let's get started with that. If you're trying to understand that, this would be a perfect video for you to watch, all right? And just a little recap, my name is Zevi Shafran. I'm the owner of a company called Loanbrook Inc. in Woodland Hills, and this is what I do. So let's dive right into it, all right? Getting pre-approved for a purchase, all right? Pre-approved. So when a borrower tells me they want to get pre-approved, I condition them for some documents. Now, specifically what I want to look for are income documents, because this gives me an idea of what I'm working with. And then for the expense, we have to run credit. All right? So I can look at the income piece, and then I can figure out, all right, this person makes X amount of money. And then for the expense piece, I typically request authorizations. So we're going to send out authorizations to you, and you're going to sign them electronically and give a copy of a credit card because it's a third-party vendor. It's important to know that in a financing transaction, the only thing that the borrowers typically pay out of closing is for third party, which are your credit and your appraisal. And the reason is these vendors don't really care if your transaction closes or not. They issue a service and they give a report, and when they do, they want to get paid for it. Basically, that's how it works. So you're walking through the door today, you're like, Zevi, I would like to get pre-approved. What's next? We send you a secure link where you can drag and drop your documents, your income documents, along with your assets. Because think about this, if you're telling me, I want to buy this property with 20% down, I need to verify that you have 20%. So we have income, and we're going to request assets. Okay? That's a plus. So we can verify that you can qualify, and we can verify that you have the assets to close. Then what we're going to do is we're going to send you a document, which is basically called, it's for this right here, it's called authorizations. So we can run your credit. I can't just randomly run people's credit. It doesn't work that way. I need authorization, and it also allows me to share information. All right? So you sign your authorization, we can go ahead and run your credit. I will size up your income against your expense. And let me elaborate on that so you understand. Typically speaking, and it doesn't matter whether you use a wholesale lender like myself or a Bank of America, Chase, Wells Fargo, meaning institutional retail, because the guidelines are going to be the same because the end user buyer is also the same. Let me elaborate. So you have typically for agency loans, which is non-jumbo loans, you have Fannie Mae, okay? And you have Freddie Is it like that or is it a Y? I don't remember. Freddie Mac. Okay, I actually think it's a Y. So these two agencies will actually buy your loan after it's been funded. So the way this works is you got to follow their guidelines to make sure that once this loan is originated, they actually buy it. Now, you might have heard real estate agents, if you're shopping for a house, say, we want the DU approval or the LP approval. So these two agencies, Fannie Mae right here and Freddie Mac, either with an IE or a Y, I guess we'll look it up later, they have something called the DU findings or the LP findings, meaning that whatever you came up with up here, you ran it through the system and they actually made a credit decision based on the information that they've received. It's preliminary because it hasn't gone through underwriting. And this could be tweaked. They're basically going to make an electronic decision based on whatever information you put up here. Now you got to make sure the information you're putting through is accurate, because if it's not, the decision is wrong. Typically speaking, if your real estate agent is asking for this type of information, I prefer a conversation with the real estate agent because, one, I'm not sure they would know what they're looking at, and number two, it has a lot of personal information that I personally would never release to a real estate agent. But if you've been asked for the DU or for the LP, that's basically what they are referring to. Now, I want to let you, or I want to elaborate on what the approval is basically based on. So typically speaking, there's three buckets of loans, okay? There is conventional loans, right? And then there is high balance. And then there's jumbo. Now the reason I'm telling you this and how this actually affects your pre-approval is that these two are sized up in a very similar manner. When you cross over to jumbo, which are higher loan amounts, then the qualifying ratios are different. I don't really want to get too much into this. I'm just going to focus on conventional lending for right now. But just know that in this particular bucket, the overall debt, meaning the proposed new mortgage, your principal, your interest, your property taxes, your insurance, and maybe you have HOA. So this is principal and interest. That's how your payment is structured, unless you have an interest-only payment, right? And then you have your property taxes, your insurance, and in some cases you have HOA, and in some weird cases you might have something called a mello-roos, which is a builder's bond. We're not going to get into that, okay? Whatever the total of all this is, all right, there's a number right here in the end of it. You take that number plus your expenses, which were reflected on your credit report, all right? And when I say expenses, I'm not talking about your utilities or your cell phone bill or your healthcare. I'm talking about things that are actually reported. There's two types of expenses that you're going to see. You're going to see revolving charges, which are typically, I'll put it right here, okay? Revolving charges, which are typically like credit cards. And you're going to see installments, which are typically like car loans, okay? Now you might see student debt, things like that as well. And if there's no number because it's been deferred, we usually use 1%. If you co-signed for somebody and they make the payment and we can show a history of 12 months, we can omit those payments. My point is, whatever this number right here, plus your expenses, which is this right here, it cannot be more than 45 to 50% of your income to get a DU or LP approval. Okay? So you take all your expenses from, your credit report, and you add the housing, and you're going to hit this number right here, 45% to 50% of your income. And that's basically what's going to allow you to get pre-approved. All right, so hopefully that answers the question. And the process is just you coming through the door, us sending out authorizations, you sign them electronically, we issue you a secure Google link where you could drag and drop your documents, we review your documents, we run your credit, we offset income to expenses, make sure that your ratios do not exceed 45 to 50%, which I don't recommend going this high. You might get an approval. I would say to keep it, safe, you should be closer to 45%. And then hopefully that meets the requirements of the loan amount that you're trying to get, okay, for whatever particular house. And in addition to that, like I said, we do have to check to make sure that you have enough assets to put down as a down payment and cover your closing costs. If you don't, the beautiful thing about an owner-occupied is that you could also use gift funds if you don't have those, all right? So we covered a lot. If you have any questions, please, I encourage you, drop them, in the comments below. Let me know if you like this video. Give it a thumbs up. And if you want to see more videos like this in the future, then please subscribe to the channel, all right? With that, I thank you for watching, and I look forward to catching you on the next video. Take care.